Hi, folks. This is Big Mike Zlotnick, and today's discussion is going to be debt versus equity investing in real estate. And we'll cover real estate as a specific subsector of the economy. This is what we have expertise in. A lot of these concepts apply to general investing in equities as well, but most of the discussion today will focus specifically on real estate. So let's define high level what type of debt investments exist in real estate and what kind of equity investments exist in real estate. So typically a debt investment is an instrument, it's a loan. So you're investing into a loan, a first lien mortgage on a property. You're participating with other investors as a lender on a given real estate property. That's an investment in a debt instrument. You can be investing in a senior loan on a given property. You can be investing into a subordinate loan, like a second lien loan or junior debt. So when you're typically investing in debt instruments, you expect, in general, somewhat higher level of safety of principal, and the way you get compensated for your investment is in the form of interest payments. The interest payments are typically defined by the interest rate that you receive on through regular payments, monthly or quarterly, or annually, depending on the type of investment you made. So debt investments obviously carry some degree of risk, but they carry, in general, somewhat lower level of risk than equity on a 40,000-foot picture. Now let's define equity, and then we'll talk about pros and cons of each. So equity investments in real estate typically means you are an owner of a property, or you are a partner in the ownership of the property. Or you're invested with other investors through a syndication or a fund that invests in equities. So equity ownership means you are a part owner of the one or many properties, and you take appropriate risks and appropriate upside. So generally, equity investments are regarded as investments with somewhat higher risks than debt investments. Of course, things depend on the type of investments, strategy, and other variables. But on a high level, debt is senior on a capital stack relative to the equity on the same capital stack. So if we're comparing the same deal, when you take in a position in debt, you are in a safer position than the equity, just a very high level. But let's cover some of the details of pros and cons of investing in debt versus equity. So let's start with pros of investing in debt instruments. So one of the major pros is predictable cash flows. You're getting interest payments on a regular basis. The next benefit is generally lower risk. You are senior to equity, and you, as a debt investor, were a part of a debt investment. You have first liquidation rights. You get paid first as a debt investor. Next, you can have certain tax benefits. So depending on the investment, you may be investing with IRA money, and interest income is perfect for IRAs. In essence, there is no risk of what is known as a UBIT, unrelated business income tax. So when an IRA investment participating in equity, there may be some level of risk of a UBIT. However, as an investment in debt, IRAs typically have no risk of UBIT. If you invested in a municipal bond with cash, it may be tax exempt from federal taxes. So there's certain benefits to different debt instruments. You just have to know what are these benefits and how each source of capital should be deployed into the appropriate investment. And this is obviously a discussion with your tax planner, with your CPA, who can understand these benefits and give you a little bit of guidance. What is the right choice for your investment and the source of capital, IRA versus cash, for example. So those are basic benefits of investing in debt instruments. What are the cons of investing into debt instruments? So some of the negative is limited upside potential. Typically, as a lender, you receive fixed interest payments and you're not participating in the equity of a given deal. There are exceptions. Certain loans may have what is known as an equity kicker. You may get 10%, for example, interest rate, and you may get certain upside in an equity. Those investments do exist, but that's not a straight debt investment. it is a debt investment with some additional benefits that has equity participation. Those do happen, but not on a classic case. So again, you limited upside. Next is interest rate risk. So this is something very important to understand. If you're investing in debt, and that is a long-term debt over many years, you basically own a series of payments. So what has recently happened? We've seen interest rates spike through Federal Reserve, pushing interest rates a lot higher to fight inflation. What does it do to bonds or investments in fixed interest? They typically fall in value. The simplest and easiest example to understand is a 10-year treasury that was paying interest rate of, say, 1.5% before Fed pushed the rates higher. And then the Fed pushed the rates and the 10-year treasury yield rose to 3.5%. When it took place, the value of the bond fell because the investors who received 3.5% getting better benefits than the investors that receive 1.5%. And because the rate is fixed for 10 years, investors that bought the bond when interest rates were 1.5% lost a portion of the principal because the rates have gone up. It's a basic investing into debt instruments 101. As interest rates rise, prices of bonds fall in general. So there's interest rate risk as part of the investing into debt instruments. Now, similarly speaking, many banks that made 30-year mortgages to investors at lower interest rates, for example, banks that made first-lien mortgage, say 3.5% interest rates, and the interest rates on comparable mortgages rose to 6%. What did this do to the value of those mortgage bonds? They fell in value for obvious reasons, because you have fixed interest rate payments 3.5% for 30 years, while everyone else in the market is receiving 6%. So investors are not willing to pay the same price you paid for the bond, even though the bond could be well securitized at the low conservative investment to value ratio, but it is sensitive to the interest rate fluctuation, something important to keep in mind. The reverse is also true. If interest rates fall, the value of the long bonds typically rises because of reverse effect. And that can happen, and that's you're basically, when you're investing into a long bond with long maturity and duration, you're a little bit speculating on what's going to happen to the interest rates. You are sensitive to the interest rates. That's another one of the risks related to this strategy. Next, credit risk. If you made a loan to a borrower whose credit is weak or the credit has weakened, you can actually wind up in a situation when the borrower defaults, and then the lenders, you as a part of the lenders or a debt equity investor may have to foreclose on a property and then try to recover the capital that you invested. So credit risk is one of the other risk components. Next, inflation risk. In general, fixed rate debt instruments are sensitive to inflation. So this is what happened actually in the economy when the inflation picked up. The Federal Reserve was forced to push interest rates higher to fight inflation. So high inflation is generally bad news for bonds because they erode in value due to the principle that you just described. The mechanism to fight inflation, increase interest rates, and the interest rates hurt bonds value substantially. So those are general characteristics of investing in debt instruments of real estate. Now let's look at the equity investments in real estate. So equity investments, some of the pros or strengths of investing in equity is typically higher potential return. So your partner in a syndication, partner on any given deal, or your own owner. You have a greater upside if the property does well, whatever the value of strategy, whatever the market does. Equity investments typically have higher upside. On the converse side, they have higher risk, and we'll talk about that in just a second. So again, we're still talking about the pros of investing in equity of real estate. Next, you could receive distributions or dividends. So if you own stocks, those are shares of equity, you can get dividends. If you own real estate, and real estate is cash flowing, is generating distributions. So it's distributions or cash flows as an equity participant in real estate. Next, you may have some level of voting rights. On a debt side, typically as a lender, you have no voting rights. But as an equity investor, you may have certain voting rights as the participants in an equity investment. Obviously, read the financial disclosures and other offering documents to understand what voting rights you have as an equity investor. And equity investments typically create hedge against inflation. There's a good old rule, invest in real estate as a hedge against inflation. And the meaning of that phrase is that you're investing in the equity of real estate as a hedge against inflation. Why? Typically during an inflationary period of time, the rents rise on all type of properties. As rents rise, the income increases and the value increases. And that is a hedge against inflation in equities of real estate. Now, let's cover some of the negatives or some of the cons of investing in equity of real estate. So we talked about upside when the deal goes well. There's also a downside you're taking on a higher level of risk. As an equity investor, you are subordinate to the debt investment on a capital stack, meaning that if you're an equity investor in a syndication, real estate syndication, there's a mortgage ahead of you. And if the deal doesn't do well, if there are problems or whatnot, the mortgage gets paid first. So you're taking on a high level of risk as an equity investor. Now, there are different types of equity investments. There's a common equity investors and there's a preferred equity investment. Sometimes two different tranches exist on a given deal, and sometimes it's just common equity investment. One way or the other, if you're in an equity position, you are generally subordinate to debt. Common equity could be subordinate to the preferred equity, but the preferred equity is typically still subordinate to the senior debt. Just a high-level description. Next, there are no guarantees of income. So as a debt instrument, typically you get paid per the schedule of the promissory note. So as a lender or a debt investor, you typically expect your interest payments to come in regular intervals at a certain amount, 10% per year or whatnot. But if you're as an equity investor, you may have preferred return. You may have certain imputation as part of the offering that says, hey, you will get pref of 8%. But if the deal doesn't cash flow to generate 8%, there are no guarantees that you get your 8% distributions. So typically equity investors will receive equity distributions when there is a cash flow to distribute. But if the deal cannot afford it, or the sponsor doesn't think it's the right time to distribute, you may not receive your distributions because they're not guaranteed. Something to keep in mind. Capital loss, it's a risk. As an equity investor, you can actually lose portion or your entire principal investment. So something important to keep in mind. In some extreme cases, if you will personally guarantee a loan, so you bought a property and you're an equity investor, you put a down payment, or you put down payment with your partners, and a lender says they want a personal guarantee, also known as the PG, and you as an equity investor sign for it, and if the deal goes terribly wrong, and the bank has to foreclose, and then they can't even recover the amount of the debt on the loan, they may actually go after the personal guarantee and try to collect on your other assets if the personal guarantee was signed and in fact is in force. So as an equity participant, you have risk to principal. If you're participating in a syndication, generally limited partners do not provide any kind of personal guarantees. So your exposure is to the amount of capital you invested in the deal, and the bank cannot go after you as a limited partner in a real estate syndication or a fund. Just for clarification purposes, so most investors can understand. But the personal guarantee risk sometimes is carried by the general partner or a sponsor of a deal, and there are plenty of deals that have effectively no personal guarantees, and the loan is known as a non-recourse loan. The lenders do not expect the owners to put up any personal guarantees, and the collateral is the only thing that they can go after if they're not paid properly. The next risk is volatility. It's basically a side effect of an equity investment. It is a feature of an equity investment. When you invest in equity, you generally experience higher volatility than a debt investment. Because as a debt investor, if the deal goes semi-decent, you'll get your predictable interest payments, and you'll enjoy that. But as an equity participant, there may be higher volatility. The swings between great returns and terrible situations are broader and wider depending on how the deal goes, the market conditions, and so on. So as an equity investment in general, you have to be a little bit more prepared for higher volatility. Anyway, there are pros and cons. There is no right or wrong. Neither one is better than the other. It depends. Also, as an equity investor, you get a substantial tax benefit in real estate called depreciation benefits. So you may get normal depreciation or standard depreciation. You may also get accelerated or bonus depreciation. And those benefits could be gigantic and highly valuable. So as you invest in equity, you take all those things into consideration. Higher risk, higher tax benefits as a trade-off, higher upside potential, but you have obviously higher volatility. As a debt investor, benefits may be different, higher safety, predictable payments, but you're not getting tax depreciation. There are pros and cons, give and take. In general, real estate is an awesome asset class to invest in, depending on the source of capital, depending on your level of risk tolerance, your own goal objectives. You may pick and choose different type of investments for your own portfolio. Consult with your attorney and CPA professional, and appreciate your time and attention. Until the next time, thank you kindly.